The true origin of the Great Depression. What historians get wrong ask. Most people, what caused the Great Depression, and you'll get the same answer almost every time. The stock market crashed in October of 1929, panic swept through Wall Street, and the American economy simply fell apart overnight. It's a tidy story. It has a single villain, the greedy speculator gambling with borrowed money, and a single moment of reckoning, the ticker tape spitting out one catastrophic number after another. There's just one problem. That story is wrong. Not slightly wrong. Not oversimplified. Wrong in a way that has shaped how 3 generations have understood one of the most important events of the 20th century. Let me say that again, because it matters. The crash of 1929 did not cause the Great Depression. The crash was a symptom, a violent tremor on the surface of an economy that had already been cracking apart underneath for more than 10 years. The real damage, the structural rot that turned an ordinary recession into a decade-long global catastrophe, had almost nothing to do with panicked traders on a single Tuesday morning. What actually happened is a story that involves a currency system so rigid it strangled entire nations. A single man whose death may have altered the course of history simply because there was no one left to replace his judgment. A trade war between allies that turned economic cooperation into economic warfare. And an economy so unevenly built that the wealth of a nation was sitting, quite literally, on top of a trapdoor. And here's the part that should genuinely unsettle you. Many of the exact same conditions that produced the Great Depression are visible again today, just wearing different clothes. Think about that for a second before we go any further. We are talking about an event that, in the popular imagination, has been compressed into a single image. Men in suits jumping from windows, a trading floor collapsing into chaos, a headline screaming disaster. That image is so powerful, so cinematic, that it has essentially replaced the actual history. It's the kind of story that fits neatly into a textbook paragraph and an hour of high school class time. Crash happens. Depression follows. Lesson learned. Move on to the next chapter. But real history is rarely that obliging. Real history doesn't organize itself into clean cause and effect chains for the convenience of a curriculum. And when you actually go back and look, not at the mythology, but at the primary sources, the central bank minutes, the trade statistics, the private correspondence between finance ministers, you find something far messier, far more human, and honestly, far more frightening than the version most of us were taught. So we're not going to start this story in October of 1929. We're going to start it more than a decade earlier, in the mud of a war that was supposed to end all wars. Part 1. The war that never really ended. When the guns finally fell silent on the Western Front in November of 1918, Europe did not look like a continent at peace. It looked like a continent that had been through a controlled demolition. France had lost close to 1.5 million men. Britain had buried roughly 900,000 of its own. Germany's losses were even higher, north of 2 million. Entire regions of Belgium, northern France, and Eastern Europe had been reduced to rubble, railways torn apart, farmland cratered, factories flattened. But the physical destruction, as horrifying as it was, wasn't the deepest wound. The deepest wound was financial. Before the war, the world's major economies had been tied together through something called the gold standard, a system where each currency was pegged to a fixed amount of gold, and gold itself flowed between nations to automatically balance trade. If a country bought more from abroad than it sold, gold would flow out, tightening its money supply, cooling its prices, and eventually making its exports cheap enough to reverse the flow. It was elegant. It was mechanical. And for several decades before the war, it worked reasonably well. For the better part of 4 decades before 1914, this arrangement had underpinned an era of remarkable global integration. Capital moved across borders with astonishing freedom. A British investor could fund a railway in Argentina. A German bank could finance a mine in South Africa. Trade flowed with comparatively few restrictions, and the entire system rested on a shared, almost unquestioned confidence that gold, not politics, not personality, not the whims of any single government, was the ultimate arbiter of value. It was, in a sense, the original attempt at a truly global economy, decades before anyone used that phrase. The war shattered that system completely. Every major power abandoned its gold peg to print the money needed to fund years of industrial-scale slaughter. Government debt exploded. Currencies that had once been anchored to a fixed and predictable standard were suddenly floating free, subject to the pressures of war financing and, eventually, the political chaos of the peace that followed. And when the guns stopped, the victors faced an enormous question. How do you put the pieces of a global financial system back together when the world itself has been rearranged? Their answer was not a fresh start. It was an attempt to force the old order back into place using the tools of vengeance and denial. Vengeance toward the defeated, and denial about just how much the underlying economic reality had changed. And that attempt planted a seed that would take more than a decade to fully bloom into disaster. Herbert Hoover, a man who would later preside over the Depression itself and take much of the blame for it, wrote years afterward, in his memoirs, that the true cause of the Great Depression was the War of 1914 to 1918. It's easy to dismiss that as a president trying to shift blame away from himself. But on this one point, most serious economic historians now agree Hoover was closer to the truth than he's usually given credit for. Part 2. The Debt Machine That Could Never Work in 1919. The victorious powers gathered in Versailles and imposed reparations on Germany so enormous that many economists at the time believed they were mathematically impossible to pay. The figure eventually settled on was 132 billion gold marks, a sum so large that even calculating its modern equivalent produces numbers running into the hundreds of billions of dollars. The treaty didn't simply ask Germany to compensate the Allies for military costs. It also included a clause holding Germany and its allies morally responsible for causing all of the loss and damage of the entire war, a legal and psychological burden that would linger over German politics for the following 2 decades. John Maynard Keynes, present at the negotiations as a British Treasury official, warned publicly that the terms would cripple Germany's economy and, by extension, destabilize the entire European order. He resigned his post in protest, before the treaty was even finalized, and quickly wrote a book about it, a scathing critique of the settlement's economic logic that became an instant sensation across Europe and America. Keynes argued, with a prescience that would later feel almost eerie, that a peace built on economic strangulation rather than genuine reconstruction was not really a peace at all, but simply a delayed continuation of the conflict by financial means. But France needed that money. Its farmland had been the primary battlefield of the war, its infrastructure devastated, and it owed enormous debts of its own to Britain and to the United States. Britain, in turn, owed substantial sums to America, which had emerged from the war not just untouched by the physical destruction, but as the wealthiest creditor nation the world had ever seen. This created what can only be described as a circular firing squad of debt. Germany was supposed to pay reparations to France and Britain. France and Britain were supposed to use part of that money to repay war loans to the United States. And the United States, flush with gold and industrial capacity, was supposed to lend fresh money back to Germany so it could keep making its reparation payments in the first place. Picture that for a second. Money flows from America to Germany, from Germany to France and Britain, and back from France and Britain to America. A loop that only functions if every single link in the chain holds under pressure indefinitely. It wasn't a financial system. It was a house of cards built on the assumption that no wind would ever blow. Keynes wasn't the only one raising alarms. Economists across Europe and America warned that the reparations bill bore no relationship to Germany's actual capacity to pay, and that trying to extract it would require either crushing the German economy into permanent depression or funding the payments through an endless chain of new borrowing that simply delayed the reckoning. Keynes, in particular, argued that the entire settlement mistook political humiliation for economic strategy, that punishing a nation into poverty doesn't produce stability, it produces resentment, and resentment has a long memory, and the politicians involved knew it was fragile. American lawmakers wouldn't forgive Allied war debts because voters would have seen it as handing money to Europe for nothing, especially with American soldiers having already paid in blood. French politicians couldn't abandon reparations because their own citizens demanded that Germany pay for the devastation it had caused to their homes, their farms, and an entire generation of young men. Everyone involved, the bankers, the diplomats, the finance ministers, understood on some level that the arrangement was unstable. Nobody had the political courage to dismantle it, because dismantling it meant admitting to their own voters admitting to their own voters that the promises made during the war could not actually be kept, so the most powerful nations on earth locked themselves into a financial arrangement that was doomed by design, not because the economics were sound, but because the politics were convenient. And convenient politics, as history keeps proving, has a nasty habit of producing catastrophic economics. Part 3. The gold standard's fatal. Flaw layered on top of this debt structure was an almost religious devotion to the gold standard itself. After the war, central bankers across the industrialized world became convinced that returning to gold was the only path back to legitimacy and stability. Gold represented discipline. It represented trust. To abandon it, in the eyes of the era's financial elite, was to abandon civilization itself. This wasn't just an economic position. It was closer to a moral one. Finance ministers spoke about the gold standard the way a preacher speaks about scripture. Deviating from it wasn't treated as a policy option to be weighed against alternatives. It was treated as a kind of heresy. Britain, despite emerging from the war with an economy far weaker than before it, insisted on returning to gold in 1925 at the old, pre-war exchange rate, a decision that Winston Churchill, then Chancellor of the Exchequer, would later admit was one of the worst financial mistakes of his career. That single choice overvalued the pound, made British exports uncompetitive for years, and locked the country into a prolonged and painful stagnation throughout the entire second half of the 1920s, years before the American crash even happened. But here's what most people miss. Returning to the gold standard after the war was nothing like maintaining it before the war, because the war had violently redistributed the world's gold supply. By the mid-1920s, the United States alone held nearly 45% of the entire world's monetary gold. And starting in 1926, France began accumulating gold at an extraordinary rate after stabilizing its own currency at a deliberately undervalued exchange rate, one that made French exports artificially cheap and drew gold flooding into Parisian vaults. Between 1927 and 1932, France's share of the world's gold reserves rocketed from roughly 7% to 27%. Between them, the United States and France were hoarding the majority of the planet's monetary gold. And this is where the story takes its strangest and most overlooked turn. Under the classical rules of the gold standard, when gold flows into a country, that country is supposed to expand its money supply proportionally. More money in circulation raises domestic prices, which makes that country's exports less competitive, which eventually sends the gold flowing back out again. It's a self-correcting mechanism, at least in theory. France broke the mechanism. The Bank of France, gripped by an almost dogmatic gold standard orthodoxy, absorbed enormous quantities of gold from the rest of the world, while deliberately refusing to let its domestic money supply expand. Economists call this sterilization. In plain terms, France hoarded the gold and kept its economy artificially tight anyway. Why would a country do this? Part of the answer lies in French domestic politics. The Bank of France had only recently emerged from a currency crisis of its own during the mid-1920s, when the franc had lost a huge portion of its value amid political instability and runaway government borrowing. When the currency was finally stabilized in 1926, at a rate many economists believed was set deliberately low to guarantee competitiveness, French policymakers became almost obsessively determined never to repeat that experience. Gold to them wasn't just a monetary tool. It was a form of national insurance, a hedge against the humiliation of currency collapse. And so, as gold poured in from abroad, France simply locked it away rather than letting it fuel domestic economic expansion, treating international monetary stability as someone else's problem to solve. The consequences rippled across the entire globe. Research by economic historian Douglas Irwin has argued that France bears more responsibility for the worldwide deflation between 1929 and 1933 than the United States does. A genuinely startling claim. Irwin's modeling suggests that if central banks had simply maintained the gold reserve ratios they held in 1928, global prices likely would have risen slightly during this period instead of collapsing into a deflationary spiral. Read that again. The deflation that devastated farmers, workers, and businesses across the world was not some unavoidable natural consequence of economic gravity. It was a policy choice made by central bankers who clung to an outdated monetary doctrine with something closer to theological conviction than economic reasoning. Deflation sounds abstract until you understand what it actually does to an economy in practice. When prices fall broadly and persistently, the real burden of every existing debt grows heavier, even though the dollar amount owed never changes. A farmer who borrowed money to buy land or equipment when crop prices were high suddenly finds himself trying to repay that same loan out of a harvest worth a fraction of what it used to be. Multiply that dynamic across millions of farmers, homeowners, and small business owners simultaneously, and you get a wave of defaults and bankruptcies that has nothing to do with anyone behaving recklessly. It's simply the mathematical consequence of a monetary squeeze imposed from far above their heads. In central bank boardrooms, most of them had never heard of and could not have influenced even if they had. France wasn't alone either. Switzerland, Belgium, and the Netherlands, a group of nations historians now refer to as the Gold Bloc, pursued similarly rigid monetary policies well into the 1930s, watching their own industries wither under the weight of an overvalued, gold-anchored currency rather than break with the standard the way Britain eventually did. Some of these countries would cling to gold for years after it had become obvious to nearly every serious economist that doing so was actively deepening their domestic depressions, simply because abandoning gold felt, politically and psychologically, like an admission of national failure. What was supposed to be a stabilizing anchor for the world economy instead became, in the words of one prominent economist, a curse laid upon the economic life of the world. Instead of absorbing shocks, the gold standard transmitted them, spreading contraction from one country to the next. Like a mechanical chain reaction, nobody seemed able to stop. Picture a row of dominoes standing upright, each one representing a national economy, all of them linked together by fixed exchange rates that couldn't bend under pressure. Push one domino, and instead of the row absorbing the impact, every single domino falls in sequence, because none of them had the flexibility to simply move out of the way. If there was a single figure who might have prevented this cascade, or at least softened its blow, it was a man named Benjamin Strong. And his death just 12 months before the crash may be one of the most consequential and least discussed events in the entire chain of causes. Part 4. The man whose death changed everything. Benjamin. Strong had served as governor of the Federal Reserve Bank of New York since its founding in 1914, and by nearly any measure he was the single most powerful central banker on the planet. He was forceful, sophisticated, and deeply networked into the world of international finance, maintaining a close working relationship with Montague Norman, his counterpart at the Bank of England. The two men corresponded constantly, coordinated policy where they could, and understood, in a way many of their contemporaries didn't, that the post-war monetary system was a delicate, interconnected machine rather than a set of isolated national economies. The Federal Reserve itself, remember, was still a young and somewhat untested institution at this point, only established in 1913 in direct response to the banking panics of the previous decades. It had no long track record, no deeply embedded culture of crisis management, and no consensus about how much authority New York should hold relative to Washington. Strong, through sheer force of personality and competence, had made the New York Fed the de facto center of gravity for the entire system. Strong understood the fragility of the post-war monetary system better than almost anyone alive. While he led the New York Fed, it was the dominant force in American monetary policy, more influential than the Federal Reserve Board in Washington. Strong pushed hard for coordination between central banks across the Atlantic. He championed open market operations as a tool for economic stabilization long before that idea became conventional wisdom. In 1927, he cut the Fed's discount rate specifically to ease pressure on the Bank of England and prevent the international gold standard from cracking apart. That move was controversial even at the time. Critics, including Herbert Hoover, later blamed it for fueling the speculative stock market boom that followed. But Strong believed that keeping the global monetary system intact mattered more than policing Wall Street's excesses. Then, in October of 1928, Benjamin Strong died. Economists Milton Friedman and Anna Schwartz, in their landmark work on American monetary history, argued that his death fundamentally shifted the balance of power inside the Federal Reserve System, leaving it without decisive leadership at precisely the moment decisive leadership was needed most. Power drained away from the New York Fed and scattered across the board in Washington and the regional reserve banks, many led by men with far less understanding of international. The economist Charles Kindleberger went even further, arguing flatly that if Strong had lived, the Great Depression might have been avoided entirely, or at the very least, would have been dramatically less severe. Kindleberger's broader thesis, laid out in his influential study of the period, was that international economic crises require a single dominant power willing to act as a stabilizer of last resort, providing emergency lending, maintaining open markets, and coordinating policy across borders even at some cost to itself. Britain had played that stabilizing role throughout much of the 19th century. By the 1920s, Britain no longer had the economic strength to do so, and the United States, despite having the resources, lacked the institutional will and the leadership to step into that role. Strong, in Kindleberger's telling, was one of the very few American officials who understood this responsibility and was prepared to act on it. That's an extraordinary claim to make about a single human being. But it captures something essential about how this disaster unfolded. Institutional failure and the absence of capable leadership at the exact moment of crisis. It's a reminder that systems we like to think of as impersonal and mechanical, central banks, monetary policy, international finance are, underneath all the charts and statistics, run by individual human beings whose judgment, temperament, and even mortality can shape the fate of entire nations. Part 5. The Roaring Twenties Hidden Fault Line. Now let's turn to the era most people picture when they think of the 1920s, the flappers, the jazz clubs, the sense of endless possibility. And there was genuine prosperity during this decade. Industrial output surged. New consumer technologies, automobiles, radios, refrigerators, were transforming everyday life at a pace no generation before had ever experienced. Stock prices climbed relentlessly, and popular magazines ran breathless. Articles about ordinary secretaries and shopkeepers turning modest. Savings into small fortunes simply by buying shares and holding on. It's easy to understand why the decade earned its nickname. Radio broadcasting went from a curiosity to a fixture in millions of homes within a few short years. The automobile transformed from a luxury item for the wealthy into something an increasing share of middle-class families could realistically aspire to own. Advertising, still a relatively new industry, became remarkably sophisticated at manufacturing desire, convincing Americans that a modern, respectable life required an ever-expanding list of consumer goods. On the surface, it genuinely looked like the future had arrived early. But underneath that glittering surface sat a structural problem that almost nobody with power was willing to confront honestly. The prosperity of the 1920s was not being shared. By 1929, the top 1% of American families captured close to 24% of all pre-tax income in the country. The top 10th of 1% earned roughly as much, combined, as the bottom 42% of the entire population. Meanwhile, roughly 80% of American households had no meaningful savings whatsoever. Wages for factory workers, miners, and farmers had essentially stagnated throughout the decade, even as corporate profits and stock valuations soared to record highs. This wasn't merely a moral failing. It was a ticking structural time bomb. An industrial economy runs on mass consumption. People need to keep buying cars, appliances, clothing, food. When the overwhelming majority of a population earns just enough to survive, an economy becomes dangerously top-heavy. The wealthy can only buy so many refrigerators. They can only eat so many meals, no matter how extravagant their spending. It cannot substitute for the purchasing power of tens of millions of ordinary consumers. The economist John Kenneth Galbraith identified this unequal distribution of income as one of the fundamental weaknesses driving America toward economic collapse. And notably, he placed it first on his list, ahead of the banks, ahead of the stock market itself, ahead even of the structure of corporate ownership. Galbraith's broader argument was that an economy this dependent on the spending decisions of a narrow, wealthy sliver of the population was inherently brittle, because that spending was disproportionately tied up in speculative assets rather than durable goods and everyday consumption. When that spending inevitably paused, as speculative spending always eventually does, there was no broad base of ordinary consumer demand underneath it to catch the fall. Because when an economy produces more than its people can afford to buy, you inevitably get a mismatch between supply and demand. Inventories pile up. Factories cut production. Workers lose hours, then jobs. Spending falls further still. The spiral feeds on itself. And it does so with a kind of mechanical inevitability that has nothing to do with any single crash or panic. It's baked into the structure of an economy long before any headline event ever occurs. Meanwhile, the wealthy weren't funneling their surplus income into consumer spending. They were pouring it into speculation, into stocks, into real estate, into the very asset bubbles that were destined to burst. And many middle-class families, desperate to keep pace with a lifestyle they saw advertised and celebrated all around them, were increasingly financing their spending through debt. Installment buying exploded in popularity. Household debt climbed steadily even as wage growth stalled. If that pattern sounds uncomfortably familiar to anyone who lived through the years leading up to 2008, that's not a coincidence. It's a pattern that tends to repeat whenever wealth concentrates faster than wages can follow. Rising asset prices, stagnant wages, and expanding household debt used to paper over the gap. It's a combination that feels stable right up until the moment it isn't. It's worth pausing here to notice something else about this era. The financial industry itself had grown far more complex and far less transparent than regulators understood. Investment trusts, early, loosely regulated cousins of what we'd now call mutual funds, multiplied rapidly during the late 1920s, often layering leverage on top of leverage, borrowing money to buy stock in companies that themselves borrowed money to buy stock in still other companies. Margin lending, where an investor could buy stock by putting down only a small fraction of its price and borrowing the rest, became almost casually common. When asset prices are only rising, this kind of leverage feels like free money. The moment prices stop rising, it becomes a mechanism for turning an ordinary correction into a violent unwind. Mid-script synthesis. The pieces already in place, so before we even get to the crash itself, let's pause and take stock of what was already sitting in place by the autumn of 1929. A post-war debt structure built on a circular loop that required perfect cooperation between nations that increasingly distrusted one another. A gold standard so rigidly enforced that it was actively strangling the money supply of country after country. A Federal Reserve robbed of its most capable leader at precisely the wrong moment, leaving behind a fragmented and indecisive institution. And an American economy so unequal that its entire consumer base was standing, quite literally, on a trap door. None of these forces required a stock market crash to do damage. They were already doing damage, quietly, for years, in ways that showed up in trade statistics and gold reserve reports rather than front-page headlines. The crash didn't create this vulnerability. It exposed it. The way a sudden gust of wind doesn't create a crack in a dam, but reveals just how close that dam already was to failing. And this is exactly why the conventional narrative fails us. If you believe the crash caused the depression, then the lesson you take away is narrow and almost comforting. Regulate stock speculation more tightly, and disaster is largely averted. But if you understand that the crash merely exposed a set of deeper structural failures, a broken international debt system, an over-rigid gold standard, a leaderless central bank, and an economy hollowed out by inequality, then the lesson becomes far broader and far less comfortable. It means guarding against disaster requires watching dimensions of the economy that rarely make headlines at all: the distribution of income, the coordination between central banks, the political incentives driving trade policy, the depth of institutional leadership during moments of transition. Part 6. The crash that didn't have to be the end here is something that rarely gets discussed. Stock market crashes were not new in 1929. There had been a sharp panic in 1907, one severe enough that J.P. Morgan personally organized a coalition of bankers to stabilize the system using nothing but their own private capital and reputational weight. There was a significant recession in 1920 and 1921 that the American economy shook off relatively quickly, with prices and output recovering within roughly 2 years. Crashes, in other words, are a recurring feature of financial markets, not an automatic sentence to a decade of global catastrophe. The events of late October 1929 were undeniably dramatic. On what became known as Black Thursday, the 24th of October, nearly 13 million shares changed hands in a single panicked session, a volume the market's infrastructure could barely process. A group of major bankers, echoing Morgan's intervention 22 years earlier, pooled funds to prop up prices and briefly succeeded in calming the panic. It didn't last. The following Monday and Tuesday, Black Monday and Black Tuesday, saw the bottom fall out entirely, with the Dow losing roughly a quarter of its value across.